trust?
It's time for Who Do You Trust? Hubba, hubba, hubba. Money, money, money. Who do you trust?
Hey guys, Rafi here from the Endgame Investor. Today, let's start with a little thought experiment, and we're going to move into what the Federal Reserve does not understand about backwardation and what it means for prices. Let's do a thought experiment and take it to the most extreme that we can possibly take it. Imagine that the Federal Reserve or the Bank of International Settlements or whatever big bank you want to imagine prints $1 quadrillion. Let's imagine that this money is created out of nothing tomorrow in computer entries. And then this big bank or banks or consortium or whatever, cartel, whatever you want to call it, takes all this money and buys everything on the planet. They own every single piece of good and service that exists in the world. They own it all. This would be the equivalent of the largest possible stimulus that the planet can take. And it would end in the bank owning every single thing on the planet.
And now comes the part where I relieve you, the little people, of the burden of your failed and useless lives.
What happens to GDP in that environment? What happens to real wealth? What happens to the lives of all the people in the world that aren't the big banks? Obviously, they become completely destitute, trading this quadrillion or whatever paper nothing for the tiny amount of resources that they have left. Let's assume they have crumbs. And what is the GDP? The GDP is enormous, as it takes a huge amount of currency in these terms to trade the tiniest crumbs of nothing. So in GDP terms, in Keynesian economic terms, you have humongous stimulus in GDP, quadrillions in GDP, but everyone is destitute and the banks own everything that you actually need to survive and thrive. So if we take it down a few orders of magnitude into what we count today as stimulus, what is happening is the banks, the central banks mainly, keep bidding on goods and services through their generals, the governments, who they buy their debt, and then the government buys all the real resources and the people become poorer. Now, the people's last vestige of hope against this systemic theft is to reject the monetary medium entirely and say, okay, fine, central banks, if you want to print whatever, go do it. We're happy for you. Just keep printing and we'll consider it all worthless and you won't be able to extract any more resources from the real economy. Now, in order to keep this final crack-up boom from happening, this final reset on the public's terms from happening, the Fed or any other central bank has to pretend that the rate of price increases is under control, always under control, because if they successfully disseminate that messaging, then people continue to use their medium thinking that, yes, even though it's losing value slow enough that I can keep using it in bidding goods and services, allowing the banks to continue to steal real value from slaves. The moment that people believe that inflation will just get worse and worse, they will dump all currency as soon as they get it, and it will become worthless, and the banks will lose all the power they currently have, which means huge banking crisis. It's very messy, but that is the end game, and that is what needs to happen. That is what will happen. Now, as for right now, the only arguments that central banks can make that price increases, what they call inflation, is under control, is to say that far out inflation expectations 5-10 years from now are lower than inflation expectations now. And therefore, 5 to 10 years from now, the situation won't be as bad. Except this is a juvenile, asinine argument. And I will show you one table that will demonstrate exactly why. This is the article that I wanted to show you from the New York Fed, written on May 17th, 2022. The title is, "Do Businesses in the Region Expect High Inflation to Persist?" What he means is rising prices. He calls it inflation. Obviously, we've been through that point before. Let's skip to the stupid conclusion. This author says, consistent with evidence from household surveys, our regional business surveys indicate that firms' expectations about inflation a few years out tend to be significantly lower than the current rate of inflation. This pattern of inflation expectations suggests that both businesses and consumers view the current period of high inflation largely as a consequence of the unusual economic environment. Thus, despite high current inflation, inflationary pressures are not expected to persist once economic conditions stabilize. The argument this Fed article is making is that since inflation expectations are lower in the future than they are in the present, that means inflation the rate of price increases will fall into the future, except what the Fed, whoever this author is, does not understand is that what he is looking at is backwardation in inflation expectations. Backwardation is when the spot price of something now is higher than the price of that same thing in the future. And when that happens, you have backwardated markets, and that means that there is a shortage and that the prices of that thing are going to go up in the future, not down, because of that shortage. Now let's look at a backwardated commodity that's been backwardated since the COVID era began, and that is oil. Here we have crude oil futures quotes. This is for June 7th, 2022. Here you have July crude oil. The prior settle price was $118.50. And then in August, 116, September 113, October 110, November 108.24, December 105.92, 103.79, 109. You see the price of oil, the settlement price, goes down the farther into the future that you go. Does this mean that markets expect the price of oil to fall in the future? Is this bearish for the price of oil? Let's see, it keeps going down, 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 down. These contracts go out all the way to 2033. And the final price there is $64.41. Does that mean that markets expect, because of this backwardation, this severe backwardation, or I think $54 from the present into 2033, does that mean the markets expect that the price of oil is going to fall $54 into the future? No, it doesn't mean that. What it means is very simple. It means that oil traders or commercial entities that need oil are willing to pay a humongous premium to get their oil now rather than wait to get their oil into the future, because they need it now, because there is a shortage. There isn't really a shortage. There is an excess of money to buy the stuff with. But you see, here's the thing. As the future turns into the present, that premium doesn't go away. So as July becomes the present, then the price of July oil rises up to the current premium, unless the shortage is alleviated, which it won't be, because this is really a monetary problem. So as the future comes to the present, the premium reasserts itself, because companies would still like to have their oil now rather than wait for it in the future, owing to the shortage that is persisting. Same thing in inflation expectations. Just because inflation expectations are not as high going 5 to 10 years out than they are now does not mean that the actual buyers of stuff, which is everybody, expect the inflation rate to fall. What they're saying is they're willing to pay a premium for stuff now because they need it now and they want to get rid of their money now. What they're thinking about the future doesn't matter, because they need their stuff now. And just as in oil, as the future becomes the present, in the rate of rising prices should rise past the premium that it is now, and inflation expectations should get worse and worse in the near future. Because in a hyperinflationary environment, it doesn't matter what people believe is going to happen to prices 10, 20 years from now. What matters is what they think is going to happen to prices tomorrow. The rest is irrelevant. So just as also in backwardated markets, in oil, for example, what is the most important is the price of spot oil. Oil now, how high is that going to go? Oil into 2033, it doesn't matter. The fact that it's so low just is reflective of the premium that exists on oil in the present. So just as in oil markets, backwardation is bullish for the price of oil, and it suggests that it will keep rising even though the price is lower in the future than it is in the present, which is the definition of backwardation. So too in backwardated inflation expectations, where inflation expectations are lower in the future than they are in the present, doesn't mean that the markets actually expect inflation rates to fall in the future. It just means that there is a premium for stuff in the present, which is what hyperinflation is caused by. People wanting to get their stuff now because they want to spend the money now rather than wait for it to lose money into the future. And so what you have is a central bank that doesn't understand what backwardation even is. They don't understand that higher inflation expectations now rather than the future means a backwardated inflation market, which means that the price rises should persist and get worse and worse and worse as the premium for stuff now rises above the price of stuff in the future, reflecting the fact that people want to get rid of their stuff right now. And the higher that premium goes, the worse hyperinflation gets. And believe me, it will get to infinity at some point soon. And when that happens, the public will dump all of the monetary substitutes issued by central banks, and they will not be able to bid real goods and services away from the people anymore. And when they finally do dump the central bank monetary substitutes for good, where do they go? They go to the original money where it all started, which is gold and silver. And it really is that simple. Here's the backwardation and inflation expectations in a chart. This is the New York Fed's chart of inflation expectations 1 year out versus 3 years out. You can see from its inception until around April, May 2021, the 1 year and 3 year expectations were pretty much the same rate. But then the 1 year expectations started to climb fast, much faster than the 3 year expectations, which means that the 1 year expectations are backward dated relative to the 3 year. And the entire term structure is in backwardation, which does not mean that 3 years out, people expect that the inflation to calm down and go slower. No, it just means that they expect a premium now on everything. And as the future becomes the present, that premium will persist and widen. This is Rafi of the Endgame Investor. If you enjoyed this video, please sign up for a 2-week free trial of the Endgame Investor and see how I cover the markets on a daily basis. Or you can become my patron on Patreon, where you will get a weekly biblical commentary on monetary and economic topics. So long, and I'll see you soon.
My balloons. Those are my balloons.